Hello and welcome to Business Lunch. I'm Nisha Podar and with me as always is my co-anchor Pavitra Parekh. So truncated week this week and everybody is celebrating the festival of Ganesh Chaturthi. But let's focus on the markets today. And yes, it was a weak start for the markets. But at the moment, let's take stock of how it's faring at the moment. There have been attempts at recovery and there has been some recovery, but no let up in sight when it comes to some bit of weakness as well as sell-off because of various macro factors as well as the global factors impacting us. So more than 1% drop when it comes to both Nifty 50 as well as Sensex. Bank Nifty is outperforming the key indices today, 0.5% down in trade. So financials doing far better, but mid caps, the broader markets are definitely better. Tad bit in the red, 0.2% down in trade. Advanced decline ratio because of the broader market participation is really impacting the advanced decline ratio and therefore in favor of the advances. And in otherwise weakish kind of market, some of the counters which really catch my attention amongst the heavyweights which are still doing well and momentum plays again Bajaj Finserv, Tata Consumers, Asian Paints, Grasim, Bharti Airtel, even Eicher Motors are some of the counters doing extremely well in trade. Pavitra.
Hi Nisha, good afternoon. So right now, of course, we are seeing over a 1% slip, but considering that we did have a 350-point downtick on the SGX Nifty when we started, I think we'd probably take this with both hands. Yes, the mid-cap index and Nifty Bank have slipped into the red right now, but this market still looks resilient when you look at it in the context of what's going on in the Asian market. So take a look at some of those. Hang Seng, Taiwan seeing steep losses come through right now. For the rest of the Asian markets also, it is looking quite weak. For our own, for the Indian markets, it is really the autos which are sort of pushing this rally. A lot of the bigger names are at fresh 52-week highs today. So something like Maruti, Escorts, Bajaj has seen a little bit of a slip now, but all of these stocks holding up quite well. In fact, the Bajaj management was also extremely optimistic on demand. So keep your eye out on that entire pack. And real estate also stands out because you're seeing strong gains come through there. On the downside, it is tech and a few of the Adani Group stocks which are seeing some cuts. That's what's going on with the markets. We're going to keep coming back to this. But first up, let's bring you the big macro news of the day. India's first quarter GDP has come in at 13.5%, which is significantly below market expectations of around 15% growth for the quarter. GVA2 has come in at 12.7%, which is below the poll that we were working with. Lata is here to take us through what was disappointing and what really held up this time around. Lata.
Well, first the numbers, GDP first quarter number came in at 13.5%. The CNBC-TV18 poll or the street estimate was between 15 and 15.5%. And the Reserve Bank's projection was 16.2, so it's lower than all that. Now, if you adjust this number to the Reserve Bank's projections, then the Reserve Bank's full year forecast falls from 7.2% arithmetically to 6.7%. Now, let me just explain why this 13.5 is a bad number. At the outset, 13.5 GDP growth over 20% last year looks good. I'll tell you why it's weak. If you take the actual Q1 GDP, it is 36.85 lakh crore. And this is only 3.8% higher than 3 years ago GDP of FY20. That's a poor record of growth. The weak elements are first construction. Construction GDP has come in at 2.62 lakh crore. That's the latest quarter, which is a good 16.8% higher than last year. But it is only 1% higher than the 3-year-ago level. That is the decline in consumption. Likewise, another huge category, trade, hotels, transport and communication. It's a large segment. Now, there the GDP is 5.59 lakh crore in the latest quarter. A good 26% higher than last year, but 15% lower than what it was 3 years ago. And both these sectors are, large employers. They comprise, the small Udupi hotels, traders, medium and small enterprises, unorganized labor in construction. Now, that is the weak part. What are the strong points of the GDP? Private consumption. Private final consumption expenditure has come in at 22 lakh crore, which is 26% higher than last year. And over the 3-year level, it's a decent 10% higher, which is over a 3% compounded growth. Likewise, capital formation. Capital formation has come in at 12.8 lakh crore, which is 20% higher than last year, but a decent 6.7% higher than the 3-year-ago level. Not spectacular, but at least it's not bad. Now, following the weaker than expected Q1 headline number, many brokerages have cut their full year estimates, mostly to around 7 or below 7. Citi is the most important. They have cut their real GDP number to 6.7. They were standing at 8, so that's a huge cut. JP Morgan has merely said that they are standing at around 7%, so it's not above 7. Morgan Stanley has cut it from 7.6, where they were, to 7.2, so a 40 basis point cut. And CLSA was sitting at 6.7. They have upped it to 6.8%. But the short point is there is a very good possibility India will not get to 7% growth this year. It may be a 6 handle, maybe 6.8, 6.9.
All right, Lata, thanks so much for getting us all those important details on the macro data and staying with the updates coming in on the India's macro picture. Well, Moody's expects India's GDP growth to really slow from an earlier projected 8.8% to 7.7% in the calendar year 22. Now, they also expect a further deceleration in growth to 5.2% in the year 2023. Now, in spite of all the disappointment, well, the government has defended the GDP print and says that it is consistent with the 7 to 7.4% growth estimate for FY23. It has also ruled out adjustments to the FY23 borrowing targets. In fact, my colleague Sapna Das joins us to tell us more about the government's thought process on this and the way forward. Sapna.
Well, the government definitely has come out in strong defense of the Q1 GDP numbers, 13.5 odd percent versus the RBI estimate of 16.2 odd percent. They are very clear on the fact that this 13.5% is very much consistent with the overall growth estimation of around 7 to 7.5 odd percent for the current financial year, or even 7.2 to 7.4 odd percent. That's one. The reason that they're mentioning is that, number one, of course, in the remaining quarters, India may have to grow just at around 5 odd percent to achieve the overall growth handle of the 7% range. That's one. Second, government capex has been doing very well. 2.1 lakh crore worth of government capex between April-July. This is 62% higher Y-on-Y, and also this is a major chunk of the overall 7 lakh odd crore number that they've set out for this year. If you also look at the high frequency indicators as per government data, that's showing a big uptick. So overall, they're pretty confident that the 7 to 7.5% growth range for the current financial year is very much doable. Last but not the least, they're also not expecting any major change in the borrowing target, and they're also pretty confident about achieving the fiscal deficit aim in the current financial year.
All right, Sapna, thanks a lot for getting us all of the details. M&M's August sales flashing on your screen, and it looks like it's coming significantly above estimates. So you do have the tractor sales, which are at around 21,000. This is above the estimate that Nomura was working with for around 20,000. If you take a look at the total auto sales, they're at 59,000 units, and this is also significantly higher than Nomura's estimate of 56,500 units. So that is what we have so far from M&M, and we'll keep coming back to this as we get the finer details. But let's move on and talk about the currency markets. The rupee has been a rank outperformer today, rising 0.1% over and above the 0.5% gain that we did see on Tuesday. So the rupee is now back at the mid-August level that we saw of 79.3 per dollar. Meanwhile, bond yields too have fallen, in sharp contrast to the US, where yields are currently at a 2-month high of 3.2%. So Lata is joining us now, and she's back with us to tell us more about this as well. Lata.
Both in the currency and in the bond markets as well, India is an outperformer. The currency, rupees rallying despite all Asian EMs lower today, primarily because the dollar index is once again back at that 109 mark. This is, of course, there were strong FPI portfolio flows on Tuesday, and probably a residual amount is flowing into the market today as well. Lower crude is clearly a pro-rupee sentiment, and, that will make a rupee shorts cover. But more than that is this RBI's strong defense of the $80 mark, which is also making exporters nervous and bringing them into the market. Every time it goes towards 70 and 80 or thereabouts, people are coming in to sell, believing that they may not get higher levels thereafter. The bond rally is also very important. The 10-year yield fell to as low as 7.16 at a point in time. And remember, just last week, they were trading at 7.3%. So that's quite a rally that you're seeing. This is, of course, strong short covering in bonds because of the lower crude price, now at $94 Brent. Last week it was, 105. But more importantly, this chatter of bond inclusion is catching on, and there is an expectation that some months down the line there could be big buyers in bonds. There is also a chatter of HDFC having raised 10-year money locally. Normally when it does this, HDFC swaps it in the OIS market for a floating rate. They sell fixed and they take floating. And those people who sell the fixed to them come and buy bonds to hedge their exposures. I mean, it's a little complicated, but the long and the short of that is that there is bond buying even on for those reasons. And therefore, a goodish bit of decoupling of the Indian currency and bond market from global markets.
All right, Lata, thanks so much for putting all that into perspective for the currency and the bond market. Well, lots to digest when it comes to the macro data, GDP numbers and rating agencies' outlook as well as rupee movement. So we'll slip into a short breather on Business Lunch. When we return, stock-specific actions, SpiceJet and Zee Entertainment are on our radar today. So we get you all the details, what's triggering these stocks after this very short break. Stay tuned.
Hey guys, welcome back. You're still watching Business Lunch. Let's talk about some individual stocks which are in focus today. SpiceJet is one of them. It is trading with significant losses. It's down over 5% right now after reporting a 485 crore rupee loss in the fourth quarter. So Sonia is here to tell us more about that. Sonia.
Well, SpiceJet continues to report steep losses both for Q4 as well as Q1. Now, the company had delayed its financial reports both for the March quarter as well as the June quarter, and finally they've come out with a statement and it's not looking good. The losses have gone up substantially because of the rise in ATF prices, and for Q4 there's a net loss of 485 crores compared to a loss of 257 crores same time last year. Not just that, for the full year of FY22 as well, it's a staggering loss of 1,721 crores that SpiceJet has reported compared to a loss of less than 1,000 crores in FY21. And the latest numbers, Q1 of FY23, also indicates a net loss of almost 784 crores. Now, where is SpiceJet going wrong? Despite a recovery that we've seen in passenger demand, the big costs that the company like SpiceJet has to bear is higher ATF prices. For example, in quarter one itself, ATF prices have more than doubled on a year-on-year basis and gone up 40% compared to last quarter. The management, Ajay Singh, did mention that this is the most severe operating environment in the recent past, and apart from higher ATF prices, it's also the depreciating rupee that is a major concern for them. The stock is under pressure, down 7% today.
All right. Thanks so much, Sonia, for getting us all the details on SpiceJet. The next stock that is in focus for news is Zee Entertainment. Take a look at that particular counter, more than 5% down in trade right now. And it's on our radar because the company has two important announcements today. And the market has really chosen to take cognizance of the negative news flow. In fact, the first news flow is that the company has signed a licensing deal with Disney Star for ICC men's cricket events. And meanwhile, the stock is under pressure amid competition regulator CCI's concerns over its proposed merger with Sony. Mangalam Malu is joining us to get us all those important details. Mangalam.
Well, that's right. It's a tale of two cities for Zee. It's ICC versus CCI, and currently it looks like the CCI news is weighing on the ICC story as well. So let's take a look at both these stories individually. For ICC, Zee basically has tied up with Star to broadcast ICC tournaments between 2024 to 2027, which includes two T20 World Cups, one Champions Trophy, as well as the 2027 ICC Men's ODI World Cup as well. The deal financials are not disclosed, but analysts believe that the valuations for this or the payouts for this would be staggered given it's syndicated, and importantly, it will give them the one piece that they don't have in their sports vertical, which is that of a good sports property. And between 2024 to 2027, the linear TV viewership could perhaps increase on the back of that. But that's a 2024 to 2027 story. The concern right now is the Competition Commission of India's questions with regards to the Zee-Sony merger after their initial review, and there were reports on that as well. Now, to that, analysts believe that, because it's an initial review, it should not worry, the eventual fate of the merger, because companies are usually in constant dialogue with the regulator all through the merger process. And secondly, the article that triggered this, fear in the street was from Reuters, and to that the company said that article quotes numbers from FY21, which included the Zee and Sony combined market share upwards of 40%. And the latest data from BARC reveals that the combined market share for both Zee and Sony are sub 35%. And as a result of which, legally, there could be a case for this merger to have no further hurdles as well. And from the company's standpoint, they have said that they are in conversation with the regulator. Be that as it may, the street does not like this uncertainty, and that explains why the stock is lower.
That's right. In fact, you pinpointed, Mangalam, that it's the uncertainty which is weighing on the stock, because the company has given, first of all, one statement on their market share. And the second most important bit is that with anything to do with Competition Commission of India, there are very few deals which have been struck down by the regulator. There are always remedial measures. It's if the numbers do not match up as per CCI's eligibility criteria. So those two important points to be really mentioned and taken care of when we talk about Zee Entertainment and its merger with Sony. Pavitra.
Oh, absolutely. So let's see how this pans out. For now, I mean, of course, the stock is under pressure. It's down 5.5%. But with that, we'll move on and talk about a CNBC-TV18 exclusive now. Sources are telling us that the IRDAI is likely to look at opening up the insurance companies' distribution architecture further. Yash is here with all of the details. Yash, what are you picking up?
Well, it's very clear from how IRDAI has looked at the distribution architecture that it wants to open it up further. Very recently, the insurance regulator also floated a consultation paper which essentially allows banks, which are corporate agents, to tie up with 9 life, 9 general and 9 standalone health insurance companies. This, before the consultation paper, stood at only 3. As far as that aspect is concerned, that is taken care of through that consultation paper. The latest that we've been given to understand is that now the insurance regulator is looking at opening up the individual agent segment as well. Currently, agents are only allowed to tie up with 1 life, general and 1 standalone health insurance company, which means that they can only sell products of 1 company out of all 3 segments. We've been given to understand that the thought which is being considered right now at the regulator's front is to open it up and allow individual agents to tie up with 3 life, 3 general and 3 standalone health insurance companies. This will also require a change in the Act itself, hence it will require a parliamentary nod. But before that, a consultation paper is expected to be released by the regulator on opening up the agent side. As far as companies are concerned, this is particularly negative for LIC, and I'll tell you why. LIC essentially has about 13.3 lakh agents, the largest agent strength in the life insurance industry. Essentially more than 50% of the total agent strength of the life insurance industry. And if agents are allowed to partner with more life insurance companies, then there are chances that private players would pay these agents more commission and try to poach them from LIC, which is essentially LIC's biggest business strength as far as distribution is concerned.
That's right, Yash. Thanks so much for getting us all those details. Another way of looking at it is that the life insurance agents may get more commission out of their business. Remember, a lot of livelihoods are really dependent on this particular job. Moving on then, the government has hiked windfall tax on crude, and export duties on ATF and diesel have also been hiked as part of its fortnightly review. In fact, Timsi Jaipuria is joining us with all the important details on that. Timsi.
In the 4th fortnightly review of windfall gains tax levy, government has hiked the levy on domestically produced crude oil to 1,300 and 300 rupees per ton. The levy on export of diesel too has been hiked from 7 rupees per litre to 13.5 rupees per litre. And on ATF too, there has been a hike announced by the government from 2 rupees per litre to about 9 rupees per litre. Whereas the levies on export of petrol continues to remain nil. And the reason behind the hike continues to be the same as announced by the government earlier, that each and every review will be based on the average global crude oil prices movement. And that's what the government saw, that the movement was towards over and above $100 per barrel as compared to the last one, which was around $95 to $97 per barrel. So that's why we've seen a hike. Let's see what happens in the next review.
All right, Timsy, thanks a lot for getting us those details. And it is on the back of this hike that you have stocks like ONGC and Reliance, which are trading with cuts today. But with that, we're going to get into a short break now. When we return, Sri Lanka has reached a provisional agreement with the International Monetary Fund for a $2.9 billion relief package. So we'll get you more on that when we come back.
Welcome back. You're watching Business Lunch, and take a look at the markets. There is another attempt for slight recovery. At this point, 1.1% still down on Nifty 50, and Bank Nifty still continues to be 0.5% down. But on my radar, some of the counters which have gained in the last few minutes of trade are the kinds of ITC, Mahindra & Mahindra, after their numbers got announced for the auto sales for the last month. Kotak Mahindra Bank, IndusInd Bank, some of those counters really revving up in terms of the support given to the overall market. Now, moving on to an important development, according to sources, ONDC, that is the Open Network for Digital Commerce, is in talks with 3 suitors to come on board as investors, including the NPCI. Bank of India is also in the process of investing in ONDC, is what sources tell us. My colleague Ritu Singh has all the details. Ritu.
That's right. It is an important development because now ONDC is in the process of finalizing these 3 suitors to come on board as investors, which will take the total number of investors in ONDC to 20. We understand that the National Payments Council of India, which operates the Unified Payments Interface, Bharat Bill Payment System, etc., that is in talks to invest about 10 crores in ONDC and acquire up to 10% stake. The final stake will, of course, be decided once the entire funding round is concluded, because remember, there's already investments from Kotak Mahindra Bank, Axis Bank, HDFC, SBI, PNB. So, 17 investors, which include your public and private sector banks, among others. We understand that NPCI has already secured an approval from RBI and the Ministry of Finance for this investment, which is expected to be announced very soon over the next couple of weeks. The other 2 investors that ONDC is in talks with include NSDL and Bank of India, which is also in the process of investing about 10 crores each as well. At the end of this exercise with 20 stakeholders on board, ONDC would have raised approximately 190 crores, which will primarily be used to meet operational expenses. An important development, especially with NPCI coming on board, it is going to be significant for ONDC, which is an open network, and UPI is going to be one of the backbones, for this network to really take off.
All right, Ritu, thanks a lot for getting us all of the details. But I'm going to ask you to stay on because we also do have some important international updates coming through. Crisis hit Sri Lanka has reached a provisional agreement with the IMF for a loan of around $2.9 billion as the country seeks a way out of its worst crisis in decades. So, Ritu, take us through the details on this one as well.
Well, Pavitra, it is a relief for Sri Lanka, but do keep in mind this is only a preliminary agreement which the staff has reached with Sri Lankan authorities. The agreement is that there would be a loan of about $2.9 billion, which will be extended subject to approval from the IMF management and its executive board. And it is contingent on Sri Lankan authorities following through some of the previously agreed measures as well. This will be through a 48-month arrangement under the Extended Fund Facility, or EFF as IMF calls it. And it will help, safeguard the financial stability, step up structural reforms and ensure that there is a debt sustainability and financing gaps are closed. Remember, Sri Lanka owes about $51 billion in foreign debt, and about $28 billion of that is due to be paid by 2027 itself. So this almost $3 billion, loan will be a lifeline, although it will require a lot more, and that is going to depend on the kind of promises that the Sri Lankan official creditors are able to make on repayment of some of these goods, amid all of these economic and political uncertainties in the crisis that the country is facing.
Right, Ritu. Thanks so much for all those important details. And yes, regional security and especially the economic crisis and abetting that is extremely important for India. Let's take a quick look at the markets and how it's faring. at the moment. And yes, stable with feeble attempts on the recovery. When we really look at some of the counters which have been the losers in the past few minutes of trade are the kinds of the IT company Tech Mahindra. Tata Consumer Products had been doing very well in trade, but has seen a little bit of profit booking at the top. Hindalco, UPL, Bajaj Finance are some of the other counters also which have lost some ground in last few minutes of trade. With that, completely out of time on this edition of Business Lunch, but Mid Cap Radar comes up next, so stay tuned for that.